Hey, welcome in, everybody. Listen, thanks so much for joining. I really appreciate it. Today, we're going to talk about the top 3 things that we are watching for 2026. We're accumulating a much longer list for 2026, but I thought I'd start off with the top 3 that we are seeing in September in 2025 because we're trying to stay ahead of the curve. So let's go ahead and just dive right in. So let's see, there we go. All right, so the first thing that I am watching is crude and products total stocks. So what does that actually mean? That means when you look at stocks, which is storage for crude oil, stocks are storage because they're stored in tanks. And as you're looking at the tanks, you have inventory upstream of a refinery, which is going to be crude stocks, and downstream of a refinery, which is going to be gasoline stocks, diesel stocks, jet fuel, so on and so forth, or other oils, that type of thing. So essentially, when you look at the refinery right here, you're going to have crude on this side, and then you're going to have gasoline, you're going to have diesel, you're going to have jet, and all of these have different inventories. So a lot of people only focus on the crude commercial crude stocks as kind of the key barometer for the health of the crude oil market. Well, the health of the crude oil market depends on what's happening on the other side of the refineries, such as gasoline, diesel, jet fuel, other oils, and other residual fuel oil. So a lot of those come into play, and that's the big reason that we take a look at crude and products. So this is taking both sides of the refinery, and that's why this number is the big one to watch for. So if we take a look at where we are right now, what you can see is that we've been tracing this right underneath the 5-year average and kind of riding along that. You'll see a trend, and that trend is a separation. So let's go ahead and zoom in on this, and you'll see what I'm saying. So since I'm going to call it June forward, you can see a very significant separation between the 5-year minimums and what we're having in inventory. So when we're looking at this, it is an early indicator of where we might be going. And when we're looking at prices and things like that, the more balance that is in here, the higher that number is, the weaker the crude oil market is. So when we're looking at this, we haven't seen levels like this probably since right here, August 2022. But what you can see is a straight downdraft, and realistically, up here is where we might be headed. And if we're getting there, we're going from 1.6 to 1.8 and a half. That is going to be very bearish for crude oil markets. So that's the first thing that I'm watching. And when we're looking at crude oil, and we obviously watch refiner inputs, because that tells you how much crude is going into the refinery. So right now, we've actually had a lot that has been going into the refinery. But when we look at the storage and stocks, let's break it apart and take a look at it. So what were we talking about before? Well, if you just look at this chart, that looks very bullish for crude oil. And then you've got SPR, which is built into there. But this is the chart that we're watching, which is both sides of the refinery, upstream of the refinery and downstream. And what we're seeing here is this separation means that we are likely to enter bearish territory, and we already are on the crude oil market. So that's that's the first thing that I'm watching. And one of the other things that we are watching is distillate and diesel motor gasoline stocks. Motor gasoline is kind of hanging right around the 5-year average, but look at this. this is where a lot of momentum, negative momentum for the price is happening. And that means we went from way below the 5-year average to inside, and we're drastically, if you look at the slope of this line, I mean, we're going to overshoot the average very, very quickly. Now, again, 1 week at a time, we got to take a look, but the last 2 weeks have proven that things are looking kind of bearish. So, the second thing that we're watching is natural gas storage. So, when we're looking at natural gas storage, we are looking for the injection season, which is going to be at the end of October. That means that we have filled stocks or stocks storage for natural gas. That's going to tell us how much inventory we have available for the winter, as well as the end of winter season withdrawal season, where we end up with. Now, what I've been watching is I've been watching a couple things: production, Canadian imports, power, and LNG exports. LNG exports are likely to go up, maybe half a BCF. I've got it modeled here at 3/4 of a BCF. Between now and through winter, I also have about half a BCF less of Canadian storage or Canadian imports. So Canadian imports, they have opened up. Canada has opened up the Kitimat LNG, which means there's less gas available. Now they've been drilling a lot, so we've been getting some excess. I don't think that's going to be happening anymore. I think we're going to see moderation there, and that moderation is going to result with half a BCF less of Canadian imports. Production, I'm going to touch on because that is another one that I'm going to touch on after this. But residential commercial, I'm expecting that to be higher, and power. But when I look at this, most of the models project that we're going to end the injection season at 3.9 TCF. I have my number at 3.8, and this model spits out 3.8. So that is what I'm looking at right now on September 22nd. I'm recording this on September 22nd. So 3.8. If we have a normal-ish winter, very similar to last year, we could exit storage. Now, the 3-year average is about 1.7 TCF, but we could exit the storage season at 1.2 or 1.3. That would be significant. That would mean natural gas prices are probably going to be 5 or maybe even higher than that. So right now, what I'm watching is the end of season forecast, which is going to be 3.9 to 3.8. This is already transpiring because many analysts were projecting 4.0, 4.1. I was projecting a lot lower. I think the initial part of the season I had 3.6, but I've got it at 3.8 right now. So let me know in the comments what you think end of season storage forecast is going to be. So when I'm looking at this, one thing to bear in mind, this is hitting averages, and those averages were at lower production levels and lower demand levels, meaning we're more open to volatility when there is a supply shortfall or a demand increase. We saw this past year with records in January on 1 week. So that was definitely coming into play. So projection number 2 is storage is going to drive natural gas prices up. And if you combine that with, where's the other one? If you combine that with, well, let me go back here and we'll just go to storage and stocks. And if you combine that with what we're talking about here, which is bearish, that means there's going to be less activity in the Permian, which is a big source of natural gas supply. That means that we're going to drop on crude oil. And as we drop, natural gas supply is going to be restricted, so we could see a lot of upward momentum in natural gas this winter. So we're not financial advisors. Read the disclaimers down below. I'm expressing my opinion, so these are my opinions and my opinion only. So the last thing I want to take a look at today, the third thing, is the trajectory of production or supply. And what you can see on this chart is since 2021, we have been in a decline on how much new production we're getting. Essentially, if we're above the zero line, we're growing. And now I want you to look at the scale. We're about right here, which is about 30. Okay. That is 30,000 barrels a day for 1 month, meaning we will have grown by 30,000 barrels a day. That is not much when we're producing 13.4 million barrels. 30,000 is nothing. It's a rounding error. So our trajectory is with the number of rigs that we have working, this number is headed down and we might even head into decline soon. So that is actually what is next. Now, natural gas, this is interesting. We've actually been in decline since, what is this? December of 2023. Now, you may ask yourself, well, why has production increased during that time? This is a calculation based upon the mechanical declines in the field combined with new production. So new production that is coming online. There are two factors that aren't taken into play here. One is in the Haynesville and the Utica, we have high pressure gas that has a flat decline. So it's not declining because it is restricted by pipeline pressure. So what that means is that extra gas is filling the pipeline from those fields, from those back pressured fields as conventional wells drop off. So that means we've remained remarkably flat when it comes to that. I'll show you another chart on that. Let's actually go right here. And this will articulate it very well. And if you look at this, for the most part, we've been relatively flat. Yes, we dropped in 2024. Big part is voluntary curtailments alongside a lot of winter activity. And then the rest of the year we climb back up. But what you can see is kind of a stalling. Now we have increased a little, but that increase is really the extra gas from Haynesville and Utica that is filling the pipelines. So the second thing that is happening, let me get back to the right tab. Where am I? Here. Okay, so that is the Haynesville and Utica. All right, so the Haynesville and Utica. And the second thing is the Permian gas to oil ratios. So as new wells are drilled in the Permian, there is a portion of gas or how much gas per barrel of crude oil. And that has been on the increase over time. So the Permian wells are getting gassier. And as Permian wells mature, they get gassier as well. So that is actually the second thing that is a factor at play. But when I add all this up and we look at this chart right here, yes, we may add a little, okay? So 2 BCF on 106 BCF is not a lot. That's a little. I don't expect that to continue, and I expect us to bounce around and eventually decline, but that decline may take a while because of the Haynesville and Utica. So the three main factors that I'm looking at is one, crude oil markets are likely headed down going into 2026 because we have weak demand for distillates and gasoline, And when we look at the crude and products total stocks, that's what it's telling us. So 2026, that it looks like it's headed down. Then on the natural gas supply side, well, let's actually go to the storage projection. The storage projection currently, the models are projecting 3.9 TCF end of injection season, and in October, I think it's going to be 3.8. And at the end of withdrawal season, we're going to be around 1.7 per the averages. I think we're going to be down around 1.3. So that means bullish for natural gas over a long period of time. We're talking 6 months. We're talking into the first quarter of 2025. So the last thing is going to be volumes or supply. Crude oil headed down, natural gas treading water. Natural gas may be able to tread water and hold off decline a little bit better than crude oil, but that's because of Permian gas to oil ratios as well as high pressure gas in the Haynesville Utica. So anyhow, if energy markets is your jam, if you want to understand a little bit more about the energy markets, we do have a website and a subscription service down below. Hopefully this helped give you an idea of what we're looking at going into 2026, because it's important to start looking at 2026 right now. So listen, thanks so much. Really appreciate you stopping in. Let us know in the comments. Let us know if you like this, if you want to see something different, and I look forward to seeing you next week. Thanks so much.